Thank you. So the whole getting your house ready could take a week. It could take a month. There's usually a budget that we come in and suggest some recommendations that you have to renovate in the property, because you remember you've been living there for quite some time, and then we want to make sure the house is ready. It's house ready when you decide to sell it. And that takes time, takes money. And then there's documents that you basically sign that allows the agent, myself or another real estate agent, that gives permission to start selling your property. And in those documents, very important, it actually says that you are that you have the taxes, not taxes, excuse me, that you are, that if foreign, some taxes may apply because you're a G4 visa holder. And I believe the term is a non-US taxpayer. So there's forms that you sign when you decide to list your property, when you are selling your property, and the contract comes in, that there's a check marks that you check off. And when you go to closing, also there's documents that you are affidavits that you say that, yes, I am this FERPTA thing that we're going to talk about today may or may not apply to you. Again, we have, it gives me great pleasure to introduce Marty, who's basically is going to take over the presentation and start talking about, what happens when you decide to sell your property, right? So Marty, thank you so much. Martin, thank you so much for joining us today.
Thank you, Arturo. Okay, the topic, successful home selling strategies for G4 visa holders. Let me point out that while it says G4 visa holders, this requirement by the IRS applies to any foreign entity or person.
I don't have your screen share up.
Screen share?
Yeah. Escape.
Sorry, guys. Take just a minute to.
It's up there.
What is it now? Here's your Zoom. Where did it disappear to?
Is a stream share there?
No. One sec.
Sure.
Zoom disappeared too.
All you gotta do is click that screen share button on this screen. This one.
No. There we go. Here it is.
There we go.
There
Okay.
we go. Zoom disappeared for us.
Okay, sorry about that. At any rate, the point I'm trying to make is this is not, the IRS isn't picking on G4 visa holders. This applies to any foreign person or other entity when you're selling real property, like your residence or a rental property. So it applies to actually a bigger audience than the G4 visa holders. We're going to go over the requirements here. And one thing is, what are the tax input, but more importantly, how do you deal with it? We invite you to ask questions, and you could use the chat to ask the questions. Preston will be monitoring that, and at the end of the presentation, we have allocated time to address your questions. Please, when you ask a question, try to keep it general and don't provide personal information like specific numbers, values and stuff like that related to your specific situation in selling your home. There's good news and bad news in this presentation. The good news is that the tax rates are generally the same as those for US individuals and corporations. So there's nothing different. Basically, you're being treated as a US taxpayer as far as the sale or purchase of real estate. Also, there is a capital gains exclusion for US taxpayers, and that is applicable to foreign persons as well. And I'm going to talk more about what is a foreign person in the next couple of slides. So much for the good news. There is also some bad news. One area of the law which is very different than what it is for U.S. persons is the case of the death of the owners of the property. What impact will this have on your heirs? It's a big impact. While this topic is rarely mentioned in any discussions about FIRPTA or anything like that, it's something you need to be aware of, as you need to consider the impact, and we'll talk more about that later in the presentation. But this could be a factor in your decision on whether or not you want to sell your house, or you have to sell your house. Okay, FIRPTA. What is FIRPTA? Foreign Investment in Real Property Tax Act. This act was enacted in 1980 by Congress. And prior to that, foreign persons were exempt from U.S. tax. So that all changed back more than, all the way back to 1980. FIRPTA authorizes the U.S. to tax foreign persons on the disposition of the property. That means you will be taxed on the sale if there is a profit on the sale. Tax is collected via withholding at the time of settlement. And what that does.
Hey, Marty,
Yes,
you want to advance the actual presentation? Sorry, I'm not sure if you're there or not.
I'm sorry.
Advance the PowerPoint.
Oh, I'm sorry.
Arrow key.
Yeah. Okay.
There we go. Thank you.
So what that withholding at settlement does for the IRS, it makes sure that you're going to pay the tax if you owe tax, because they're taking it up front. There have been a lot of problems with foreign persons leaving the U.S. without paying the tax, and then the IRS has a hard time collecting. So they're taking it up front, and that presents a big challenge to sellers of real property, because it impacts how much money you're going to walk away with at the settlement. You may get some of it back, but you have to have the withholding in order to provide a source for paying the tax if there is. Okay, here are some definitions. Disposition is anything you do to that house. So if you could sell it, if default on the mortgage, that's considered a disposition. Even if you want to gift it to your kids or somebody else, that's all considered a disposition, and the FIRPTA rules apply. A foreign person is basically, from an individual point of view, is anybody who's a non-resident alien, but it also applies to corporations and partnerships. And again, as I said earlier, all foreign persons are subject to FERPTA. One of the problems with FERPTA is that it has a lot of moving parts. There are a lot of players. There's the buyer, the seller, the settlement attorney, the tax guy, and the IRS. So anytime you have all those players, this thing is going to be complicated and it's going to take a long time. This was highlighted during COVID, because during COVID, some of these processes took several years. So thank God we're over that. But it does take a lot of time, and there's a lot of dependence upon other people. And one of the key issues is the settlement attorney. Typically, the buyer chooses the settlement attorney. Now, I understand that there are cases where the seller could do it, but I think commonly the buyer does it. So that already puts the seller at a disadvantage, although while the settlement attorney represents both buyer and seller at a settlement, the guy who pays this settlement attorney is the buyer. But the seller, in order to comply with FERPTA, has to depend upon the settlement attorney, and the taxpayer has to, the tax preparer has to depend upon the settlement attorney to get all the right information from the buyer in order to have us do what we need to do to try to help you reduce or eliminate the withholding.
Can I interact there for just a minute?
Sure.
So one of the things that and Marty is correct in terms of, when the time goes, you go to closing, the buyer is specifically here to the interstate, the 3 states we have here. They're the ones who have a choice of selecting the entitlement company. However, in these situations, we always, as we represent sellers, we recommend, we work with title companies who are familiar with, how to handle the money, how to handle the cash, and things, and that's very, very important. And as a seller, you have a choice. You sort of explain the situation to the buyer's agent if you're selling, and then 9 times out of 10, you'll have a very amicable buyer who understand your situation, and then you could use the company that you're preferring to use, right? So, thank you.
Thank you, Arturo. And I can't emphasize too much that the settlement attorney has a key role in this, because we, as the preparer of documents related to FERPTA, depend upon the settlement attorney to get information for us. For example, the names and social security numbers of the buyer or the buyers. And I've had some bad experiences with the settlement attorney. For whatever reason, I don't know, other than laziness, said, well, you have to do that. Well, that's very hard for someone like me, who's representing the seller, to talk to the buyer and say, hey, give me your social security number.
Exactly.
And it makes it difficult. And, there have been some cases where I wouldn't do any FERPTA cases if a certain settlement attorney was handling it for the buyer, because of non-cooperation. So that's an important aspect. So the settlement attorney is a key player. Okay. In the end, though, the seller is the stuckee. The seller is the one who has to leave money on the settlement table to cover the FERPTA withholding and pay any taxes for a tax return if that's necessary, or any other paperwork, has to pay the tax professional to do that. The seller may be able to recover some or all of the withholding. Again, it takes a lot of time to do that. And the amount that's in question is that depends upon the gain and loss on the sale. So the seller has a couple options: filing a tax return or filing for a withholding certificate. And in many cases, they have to do both. I'm going to explain why. And of course, it's much more complicated if the seller doesn't have a social security number or an ITIN. And then it's a much longer process. Generally, the tax withholding is 15% of the amount realized. The important word here is realized. Ordinarily, when one sells a house, he or she is focused on how much money they will receive at settlement. Here is an example, a simple example of what we're talking about. Suppose I go to Arturo and I say, Arturo, I want to sell my house. Now he comes to my house, does comps, looks at the condition of the house and so on, and would recommend a listing price. And let's say in this case, he says, let's list the house for $1 million. All right, then there are settlement costs. And for purpose of this example, I'm going to say it's $50K for $1 million sale. Actually, I suspect it's higher than that, but to make the math easy, let's say it's $50K. And then he checks with my bank and finds out that I have a $450,000 principal balance on my mortgage. So if we calculate how much money approximately I'm going to walk away with at the settlement table, it's the $1 million minus the 50,000 settlement costs minus $450,000 I have to pay off the bank for my mortgage balance. So now that leaves me with $500,000. So does that mean that I'm only going to have 15% of $500,000 or $75,000 withheld? The answer is no. In plain English, the bottom line here is that it's the sale price, which is a little disturbing because the sale price doesn't take into account that I'm not walking away with the sale price. In this example I used, I'm walking away with half the sale price. So the important phrase here is the sum of. The sum of. Oops.
That's it.
The sum of, okay? Because what the IRS is doing is they're saying the amount realized is the cash paid plus the fair market value of the property, other property, and let's forget about that. In most cases, there isn't any other property, and the amount of liability assumed by the buyer or to which the property is subject to. So what they're doing is they're adding the mortgage balance instead of subtracting it like I did in my example, because they're looking at this as I'm benefiting as the seller. I'm benefiting that I no longer have a liability. So the IRS interpretation is that the sale price is the controlling number, not the net price. So that therein lies the problem. Welcome to the wonderful world of FIRPTA. Now, there are some exceptions. The seller, if the seller is not a foreign person, there is no FERPTA. The buyer has definite plans to use the property as a residence, and the sale price is $300,000 or less. In general, in this area of the world, that's very rare that you're going to have this with only a $300,000 sale price situation. The withholding rate goes down to 10% if the buyer intends to use the residence as a residence and the amount realized is $1 million or less. The asterisk here looks like a joke. It says the buyer must reside in the property for at least 50% of the number of days, essentially over a 2-year period. Just think about what happens. The IRS going to sit around for 2 years checking on this? Absurd. So while I'm assuming what happens is the settlement attorney is going to make the buyer sign a statement just to cover his rear end that they intend to reside in the property to meet this requirement. Suppose that doesn't happen. 2 years go by. Who's checking on this? It's an absurd statement. This is just another example of the issues that come up when we're dealing with IRS and the requirements that are basically written by lawyers and not really typically a practical issue here. So we recognize that's the way it is, and I'm sure the settlement attorney does get a signed statement by the buyer, but it ain't going to happen. No one's going to check it. Okay, so one of the mechanics. So FERPTA says the buyer is responsible for making sure the money is withheld. What does the buyer know? The buyer's a regular guy just like you and me. What is the buyer going to know whether about FERPTA applies or not? So it's the settlement attorney takes over for the buyer and makes the determination whether FERPTA applies and what the withholding is. And in the case where withholding is made, it's reported on an IRS form 8282, and there's a 8288A, and that's just a document that documents how much money is withheld. And that's needed by the seller when the seller goes to recover that money, is proof of the amount that was withheld. The settlement attorney submits the payment and forms to the IRS by the 20th day after the date of settlement. A reduced rate of settlement may be allowed if a withholding certificate for disposition by foreign persons is issued. So that implies that we have to submit the withholding certificate as early as possible. But the general rules are that because the certificate has to have the name and social security numbers of the buyers, you really need to have a contract and know exactly who the buyers are, and you need to get that information through the settlement attorney. So the certificate enables the settlement attorney to place, if we prepare, typically the tax preparer does the generation of this certificate. So if we prepare a certificate and shows that the withholding computed should be less than what's going to be withheld. That gives the settlement attorney the go-ahead to, instead of sending the withholding to the IRS, putting the money in escrow and holding it until the IRS processes the application for the certificate. If it turns out that we come up with that there should be no withholding, and I'll explain why that could happen later, it eliminates the need to file a tax return because there won't be any money to try to recover. This potentially speeds up the funds recovery process, but still takes about 90 days after settlement. So pretty much you have to assume that at the settlement table, in addition to walking away with the proceeds, as I explained earlier, you're also going to walk away with 15% less of what's due to you and have to wait about 90 days.
You know, and one of the things that's very important as well, that if someone is looking to, if you need the proceeds from the sale to purchase the property, right? If you're moving up, you know, all of a sudden in the scenario that Marty was talking about, you have $100,000 or $150,000 that's sitting on an escrow, right? That you will not be able to use for the new purchase, for your potential down payment of the next property. So, and you know, this conversation, it's basically you have it, you know, we as an agent of yours, I have that at the beginning, right? I mean, why are we selling? Are we moving? Are we buying something else? So that's definitely something we have to basically align and get it out the open. If you know, why is the purpose of moving to something else or selling your property per se?
Thank you, Chair. Now, a worse situation is, for whatever reason, you're not going to make any money.
That's well, exactly.
And what happens is you have to, you know, the settlement attorney says you got to bring money to the table. And whatever money you have to bring to the table is going to have to include the FERPTA withholding, which you're not going to get. So you have to wait. And so I've had cases where they haven't been able to sell the property because they couldn't come up with the money. So now you have to look at some kind of a bridge loan or borrowing some money from somebody, you know, a relative or whatever. It makes it very difficult in that case. So you need to be on the lookout for that if for whatever reason you think you're not going to be able to have enough money to go to settlement.
Excellent point.
The primary focus of this is to document the gain and loss of the sale. There's no gain, the seller recovers the entire withholding, albeit may take 90 days. If there is a gain, the seller recovers the non-taxable portion. Okay. A Form 1040 NR. This is what happens if you have to file a tax return. Foreign individuals file a 1040 non-resident tax return for the tax year of the disposition. If you're married, you have to file two married filing married filing separate tax returns, 1040 NRs, because there is no such thing as a married filing joint 1040 NR. If it turns out the spouse is not a foreign person, let's say she's a U.S. or he is a U.S. citizen, he or she is not subject to FERPTA. So then only 50% of the withholding is made. It assumes of 50% ownership, which is a general case. The rub here is, what is the date of disposition? The settlement attorney, the settlement date is very important. If disposition occurs, and let's say you sell the property, or you have a contract for sale of the property in December of 2025, but it doesn't settle until 2026. You have to wait until 2026 to file a 2020 tax return, 25 tax return. Big delay. So strategizing this whole process is an important part of, first of all, understanding all the nuances here, and then strategizing what to do about that is very important. That's why you need to have a real estate agent who understands this, and that you yourself as the seller need to understand this. So the seller's funds are tied up for a long period, unless a longer period, if the settlement doesn't occur in the last quarter of 2024, in this time, in this example. It's just something you need to be aware of. So strategizing if and when to sell is an important aspect of this whole process. Okay, how do we figure the gain or loss? You look at the sale price minus the cost of the sale minus the basis. Basis is how much did you pay for the property to start with? How much did it cost you to buy that property in terms of settlement costs? The cost of any improvements that you made, you remodeled the kitchen, you add a bathroom, whatever, and then any depreciation taken. In general, if it's a rental property, if it's not a rental property, there wouldn't be depreciation, except if you have a business and you're claiming a home office, in which case there's some depreciation. So this is the general formula. The good news here is that there is a Section 121 exclusion. Section 121 refers to a section of the IRS tax code. And so if you live in the property for 2 of the last 5 years, you are entitled to a $250,000 exclusion on the gain. Married individuals would be $500,000. Of course, in this situation here, since you're filing a married filing separate return, each of you would be entitled to $250,000 exclusion if in fact you meet the criteria. If it's less than 2 out of 5 years, but there are circumstances, certain circumstances for selling the property, you may be able to get a portion of that based on the ratio of the number of months over the 24 months, representing the 2 years. For example, if you retired from the World Bank or whatever, and you're moving back to your country, that would be a reason for not having 2 years, but still getting some. But that's probably not a good example, because if you're working for the World Bank, most likely you've been working there for a much longer time. But there are things like divorce and illness and etc. So there are a lot of options here in terms of your exclusion. Rental property is a lot more complicated. The gain and loss is computed as in the case of residency, but there's the added factor of significant depreciation, which is a big expense driver. And one of the things you need to do is, even if you have a loss on an annual basis on the rental property, losses often occur because depreciation is a large factor. Depreciation on a residence is over a 27-year period. So if your basis is $1 million divided by 27 years, straight line, that's a significant amount of money, which could drive your bottom line into a negative area. So if you have no other taxable income, remember your income from your G4 visa job is not taxable. So you don't have to file any kind of a tax return unless you have US source income, let's say from investments, or maybe you have a consulting business on the side or whatever. A lot of people don't have that. So you have no need to file a US tax return. So if you have a real estate rental expense, then you don't get any benefit from putting that expense down on your tax return, because you have no positive income to subtract from the loss. So it's very dependent upon whether there's a gain or loss. And we'll see how that works in these examples. Okay, in scenario one, you're a world banker, you own the home, you sell your house, and you return to your home country, or you rent out the home. In order to deduct rental expenses, you have to have active and material participation. And in this case, could you meet that requirement or not? The next chart will give you the answers. Can the rental losses be deducted? In scenario two, you're working and living in the US and you invest in a rental property. What is your active participation qualifications? Can you take these losses? Now, this only applies in the case where you do have losses. Okay, so the answer in case one is no, you don't have active participation because you're in your home country, whether it's South Africa or Buenos Aires, Argentina or whatever. You're over there, and the rental over here. You most likely have a rental property management company and so on. So you really don't qualify for writing off the losses. And what you're going to see is that's probably a good thing, and hopefully you'll understand why that is when we look at the next few charts. In case two, you might be able to argue that you have active participation. Let's say you're living in McLean, Virginia, and your rental's there, and you're collecting the rent. And if you have a leak, the tenant calls you, and you call the plumber, et cetera, et cetera. So there's a much better chance of having active participation. Can you take off the losses? And the answer is maybe. That brings up the topic of passive activities. Rental property, by definition, rental ownership is by definition, the IRS passive activity. You can't take off passive losses unless you have passive activity income. This is a very complicated subject, and we're not really going to get into the details in this presentation. That would take another couple of hours. The key point here is that you do not lose these losses. What happens is if you have a loss and you can't take it, the loss is suspended and put in a bucket, and it's carried forward to the next tax year and the next tax year and so on, and it's only released upon the sale. So that's turns out to be actually a good case, because there are special rules that says you can deduct up to $25,000 based on a certain amount of income, but you must actively participate, and there are AGI limitations, as I mentioned. So here, basically, having your losses suspended is a good thing. Now, if you have positive income every year from your rental, then you're not going to have any suspended losses. And therefore, when you sell the property and you have a gain, you have nothing to reduce the gain. But that's the way it is. You're benefiting from the positive income for all the years it's been a rental. Okay, so to deduct in the scenario one, you have your bucket full of unallowed losses. They accumulate, and is that good or bad? And as I think Ray suggested, that's good, because when you sell now, that bucket's emptied out and subtracts from any gain, and reduces or eliminates any tax that you have to pay. And I've just had a case where there was a significant gain in the sale of a property. My client lived overseas, had a property in Chevy Chase, Maryland, sold it. He had a large gain, but he had the property for 15 years, and he could not. He had losses every year because of high depreciation, and the losses accumulated to over $300,000 over those 15 years and wiped out all of the capital gain, and he owed no taxes. So that's actually a good thing. In scenario two, you generally assume you have little or no other U.S. income here. Allowed losses help reduce or eliminate the taxable income upon the sale. And the strategic decision here is, do you force or suppress the active participation? You need to work this out with your tax advisor. That's why tax planning is an important part of this, because you'd like to be able to figure out the best situation for you. Now, technically, you can't just make up and say, I don't have active participation. You have to have a rationale for that. And sometimes it takes a lot of planning. So just emphasizes again the importance of getting involved with a tax professional early in the process when you have a rental property. Trying to do all this with TurboTax, forget it. It's not going to work. Okay, so that's basically the situation with FIRPTA for residences and rental property. some tips on dealing with FERPTA. Be alert to the potential FERPTA issues early. It applies to buyers and sellers. Because I didn't emphasize this, but if for some reason FERPTA is required and it's not executed, the buyer is responsible, and the IRS is going to go to the buyer to collect the amount of money that should have been withheld. So you need to be aware of this. You should select a realtor with good knowledge of FERPTA. I have to tell you that I recently had a case where I got a panic call 5 o'clock in the afternoon from a new client who found out a few hours before he called me that at the settlement tomorrow they were going to withhold $70,000 of FERPTA money. His realtor never told him that. Bad news. I mean, I've actually known of some cases where there were lawsuits because of that. So it's very important that you are aware that you need to hire a realtor who knows what he or she is doing.
And let me just add to that,
Tomorrow,
yeah. Can you hear me?
is a very important part of this. Don't try to navigate this without the help of a tax professional. Now, it turned out in the case I just cited, the seller went ahead and went to settlement. He came up with the money he needed. We ended up filing a tax return for him, and he got his money back in record time. And I think it's because he had good information, and we prepared a good document in the tax return, and he got his money back quick. So he was very happy. But it didn't reflect very well on the realtor, that's for sure. Buyers, make sure you use a tax professional to file annual tax returns if you have a rental property. So if you're listening and you have a rental property, hopefully you are filing tax returns, because in order to accumulate the losses, you have to file a tax return. I had a case where a couple, both husband and wife, were G4 visa holders. They sold their property, went back to, I think it was South Africa. And I guess a few years later, they decided that they may want to claim their FERPTA withholding. They never filed tax returns for their rental properties. I had to do 5 tax returns for each of them. Remember, you can file a joint tax return if you're a foreign person. So I had to file 5 tax returns times 2 to generate the suspended losses. And then the wife finally got her money back. There's $1.25 million sale. She got her $62,500 back. And the husband didn't for a very long time. And then the husband got a letter from the IRS, said, "Hey, buddy, you've been trading stocks and you sold a lot of stocks over the years and you never filed a tax return. So we're not giving you your money until you file a tax return." He never kept any good records, and he had a lot of stock that disappeared off the stock exchange, and he didn't have any basis information. So his gain was based on 0 basis. And so he finally got his FERPTA money. That's about $20,000 in taxes he owed the IRS. So it's very important that you stay on top of things and keep receipts if you do have other income and so on, and if you make improvements to your property. Sellers, you need to get educated. So starting at the time of the listing, this is a better time, like today, is a better time to get educated, to start getting educated than waiting for the listing. But certainly no later than when you list your property, because you need to ask your realtor the questions. If your realtor says, FERPTA, what is FERPTA? Immediately run and find another realtor. You should consult a tax professional to understand what are the parameters that you need to deal with for your individual case. Certainly, the contact should be made no later than the contract ratification, but in most cases, it's better. So to the extent that you have the influence, try to select a settlement attorney, one who's well-versed in FERPTA. Okay, so the last slide is this other issue about estate taxes. Estate taxes for non-resident aliens are different than for U.S. residents. A U.S. taxpayer's exemption on the estate in the current tax year is $13.6 million. I don't have to worry about that. Okay, first of all, you know, I'm not going to worry about that. I don't have $13.6 million. A foreign exemption is $60,000. So if you have a property and the owner or owners pass away, they have kids and have a property for $1 million, there's going to be about 40% tax on the $1 million minus 60,000. Significant amount of tax. So the way you work around this is find a lawyer who could set up a foreign entity and have the foreign entity be the owner of the property. This turns out to be a significant and complex deal. So this could impact your decision whether or not you want to sell your property right now, or plan on it, or not buy another property. You know, there's a lot of variables here, but you should be aware of it, and that's a purpose for telling you this. In summary, FERPTA is not optional. It's mandatory for foreign persons buying or selling a property. It's the law. You should identify the FERPTA issues early, and that'll make your life easier. The two options: filing a tax return or a certificate of withholding, and in many cases both, because if you get a certificate of withholding and it shows that you owe some taxes, they're going to withhold, and you're going to have to ultimately file a tax return to get that back. Timing of the settlement is a big factor. The tax treatment is critical, so you should use a tax professional and at least keep in mindful of the state of tax issues. Well, that concludes the formal presentation. I'd be happy to entertain any questions you have. This chart shows my phone number and my email address. If you think of questions after the fact, and I don't know if we've received any questions today or not, Preston.
Marty, I don't have any in the Q&A or in the chat, but happy to entertain some if anybody has any.
Okay. So you know how to reach us if you have questions, whether you have them now or in the future. And it's a complex subject, but we've done many of these, and ultimately they work out. It just requires a lot of patience and attention to the detail. Thank you very much for attending.
Well, I guess I will close by saying as well that, you know, you really need a team of professionals, right, that can definitely assist you from the beginning all the way to the end.
Absolutely.
Having, a good agent, a good settlement attorney, a good tax person who can, help you and just educate you and, and help you navigate through the entire process. I mean, those are keys and to have a successful transaction and just be aware of everything that's going on. So, I want to thank Martin, and Preston for giving us their time today. And, Martin provided a PDF, a version of his presentation, so we're going to be sending that out. If you have any questions, you know how to reach us, and appreciate you guys being here, and we'll see you next time.
Thanks for having us.
Thank you so
Thank you.
much. Bye.
All right. Bye-bye.